We're here with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris, welcome back. What a day it is on Tuesday. Markets are down. By markets, I mean pretty much across the board. The S&P 500 is down 1.2%. Gold and other precious metals are also down. Everything's just down. So we've talked about a scenario like this before where we have sort of a risk-off environment and safe haven assets correct with stocks. Is that what we're seeing today?
That is today. Today we're seeing a broad market sell-off, and there's quite a bit of fear in the market. We're seeing it's not just fear. We're actually seeing some panic in the stock market. We've got the panic selling kind of ratio on the New York Stock Exchange. The amount of shares being sold on the bid is spiking up today. So that's telling us that the average investor is panicking and they're just dumping shares. And when the stock market falls, we see panic selling on the New York Stock Exchange, and we see precious metals fall, especially gold. That is a sign that there's panic in this market, and there's not much you can do. Pretty much everything falls on these days. Typically, there's going to be a follow-through day on the next session, and you just got to be aware that there's actually a shift here happening right now this week that I think the stock market is on the verge of starting a new, pretty significant correction in the market. So you got to be aware of that.
Can you put a finger on what caused the sell-off today, or I guess more generally, why you think this week will be a bad week for the markets?
Well, yeah, the markets, obviously they've been pretty strong. We keep seeing them grind higher, and they're poking to all-time highs. But the thing is, over the last month or so, we've been seeing all the defensive sectors starting to perform really well and starting to outperform the stock market. And today's a day where almost all the defensive sectors over the last month or so are actually outperforming the S&P 500. So we've got the industrials the utility sectors performing well. Gold's doing well. Bonds are holding up and doing well. And they're actually showing a lot of signs of big money flowing into those sectors versus money flowing out of individual stocks of the broad market. And so when the indexes are underperforming defensive sectors and we start to see some big selling volume like we're seeing today, this week, that is a sign that, hey, big money's rotating out of the risky stocks and they're starting to pile into the defensive. And that's the kind of riding the coattails of big institutions, big money flows. And that's what I like to follow. So today's a turning point in that now the equities are underperforming enough that it's kind of time to get out of the equities market, sit on the sidelines, or potentially take some type of trade that can profit from a falling market.
Can we pull up a VIX chart, Chris? Take a look at the VIX.
Yeah, the VIX is up about 18% today. So we're seeing that really pop. And it'll be interesting to see how the day holds up going into the closing bell if it closes up near the highs. So there's fear across the board right now.
Historically, well, not historically, but compared to the pattern that we've seen in the last couple of months, it's still low, right? Are you still reading that chart in terms of looking back at history? And would you say that there's still room to climb for the VIX?
Yeah, there is. I mean, the VIX is, it's fairly low. I mean, we've been years and years with it way down in this range. I mean, going back, really as far back as you want. Not too often we spike up above 25 or 30. It's very short-lived. So we still have low volatility. There's lots of room for volatility to rise, to spike and take off. We could see, 30, 40, probably pretty easy if we do get another big downdraft in the stock market. So really today is just a wave of fear. It's nothing really dramatic, really big at this point. What we need to be aware of is that all the underlying sectors have been struggling to make new highs, and the defensive sectors are coming to life with money flowing into them. And those are the warnings, not so much the VIX here. It's what's behind the curtain. Where's the big money flowing? And big money is flowing into defensive sectors in a big way.
When you see fear like you're seeing today, are you reading that as an opportunity to buy on the dip?
Not so much. What I see, because we're in a bull market, I'm not looking to just buy an oversold dip. That's not the strategy that I use. What I'm looking for is this market to become unfavorable. So potentially you exit all positions. The stock market trades sideways like it did last September. It chops around. We see fear continue to spike up. And what it's doing is it's re-energizing the market. It's shaking out all the loose hands, the shares out of investors and traders who are nervous, putting those shares back into new investors and traders. And who knows, it could only take a week or so, it could last several months. But what it's doing is it's just creating another flag, another plateau, a level for the price to continue going higher. And so what I'm looking for is for the market to shake things out. And then when it gives us a new buy signal, when the indexes are clearly outperforming all the defensive sectors, they're back into an uptrend, that's when I'd be looking to jump back into the market for the next major leg up in the stock market. And hopefully we find a really strong set of sectors that want to rally in this next leg, because this previous leg, a lot of sectors were chopping around and there weren't really clear leaders that really stood out in terms of some big explosive moves.
Okay, before we talk about specific sectors now, earlier you said that there was a rotation into the defensives. Was that a play that you took, Chris? We talked about this, I think, last time you were on the show. Did you take a position in some of the defensives?
No, so we don't with the band trading strategy, we don't move into defensive. What we do is when defensives are starting to outperform, that's our sign to step out of the stock market, and we actually go to cash. So we're looking to sidestep this market. We're not defensive stocks. They only rise ahead of a market correction. And as soon as the market has a correction, they all collapse with price as well. All they are is an early warning indicator saying, hey, things are getting really weak and brittle. This market is about to collapse. So just move stops, trim positions, or move to cash, and then wait for a new signal.
Can we pull up a gold chart real quick, Chris? It's a good point you made in the sense that you said that when there's risk, when there's risk off, you move your capital into cash. So yeah. I'm wondering why you don't move it into something like treasuries or gold.
Well, depending on the strategy, some strategies we do. So in certain scenarios, bonds are a great play. And we have a strategy that if bonds are acting as a safe haven and they're actually showing characteristics that they're going to move higher, we actually will be moving into like the TLT ETF, which is the bond. But right now they continue to be dramatically underperforming. They're trying to put in a bottom, but they're well under their 200-day moving average. They're just not a safe haven. And they could easily trade sideways or lower while the stock market even struggles and pulls back to some extent. There's not enough upside potential because they're really still in a downtrend. But there will be an opportunity to get into bonds down the road. They always have some amazing opportunities every year. But right now is not that time to get into bonds, I don't think.
So Chris, going back to the gold chart now, we did see gold correct today. Is that an extension of the equities correction that we're seeing today as well? Or do you think that gold was going to correct anyway?
Gold's definitely struggling resistance. When you look at this rally that we've had, and we just draw a line across this chart, this is a very significant level on the chart where we've had lots of volume trade, very significant lows. Prices tested it many times, broke through it, found it as resistance. And so we're right back into this level. So this was a level that has natural resistance. The fact that there's panic in the stock market today and gold is down, 1%, clearly shows that it's getting sold off because of the stock market today. But it's also at resistance. It had a really strong pop yesterday into resistance. Typically sellers step in the next day when they see that. So just couple that with some fear today, and you get this stronger downside move in gold.
Yeah, we've talked about this before, but can we revisit this topic, the topic of gold's correlation with equities? Now, the common notion or belief amongst investors is that gold is a hedge against volatility, equities volatility, that is. And to some extent, that's true. However, like we're seeing today, that is not the case. They move in the same direction downwards. Can you explain why?
Yeah, so a lot of times gold is seen as a defensive play. When people get nervous, we can see gold prices rise. But when there's panic selling in the stock market, typically investors and traders start to sell everything. They can't take the pressure. Usually people are overpositioned. They're using too much leverage. And when the stock market starts to correct, they start to panic and they start liquidating positions because they can't take seeing all the red in their trading accounts. So they start liquidating things. A lot of times you get margin calls. As price starts to fall enough, you'll end up getting margin calls. And that's what happened back here in the March crash that we saw, April crash of last year. That was that particular scenario. Now, overall, typically gold will hold up and do fairly well. It's a fairly stable commodity, but when there's panic selling in the stock market, you definitely want to step aside, let the market cleanse itself. And it's better to get back in on the upswing than it is to hold through a full downswing. And you never know if that sell-off in gold is going to last a couple of days or it's going to last several months because it is a slow-moving kind of asset.
So correct me if I'm wrong, Chris. What you're saying is that investors see gold as an alternative to cash or as a very liquid asset. So when markets are in the red, they need to raise cash maybe to cover their margins, and so they sell gold. That's the reasoning here.
That's one of the reasons for sure. Yeah.
Okay. What about going into the future? Could you see a similar phenomenon with cryptocurrencies as more investors, institutional or retail or otherwise, pile into, let's say, Bitcoin and use Bitcoin as, let's say, an alternative to cash or perhaps even an alternative to gold? Could you see a similar pattern playing out for Bitcoin? When equities correct, they would sell their Bitcoin to raise cash. We're seeing actually Bitcoin fall today as well.
Yeah, I think there is that potential. I mean, when you look at the price of Bitcoin, it sold off with the COVID crash. It looks pretty dwarfed when you look at it, but when you actually zoom into that recent price action, Bitcoin, when there's people selling, liquidating, requiring to pull cash, I mean, Bitcoin fell 60%. So when there's a liquidation event, meaning people are panicking, margin calls are happening, everything gets sucked down with the vacuum almost. Your odds of picking the thing that goes up is really slim. So there's not a whole lot of point in trying to take advantage of that or try to figure it out.
Particular equity plays that you don't like, Chris, because we were talking about this offline. You were telling me about uranium. What's going to happen with uranium stocks?
Yeah. Well, if we take a look at the uranium kind of sector ETF, URA, there's another one that's URNM as well. But this is the daily chart. And you can just see here visually, it's starting to get pretty choppy. We've got some rallies, pullbacks happening over and over again. Now, it is still in an uptrend. But when you see the sector starting to get really choppy like this, and you start to see big elevated volume and big volume spikes, that's usually the sign that usually the end is really near. If we were to kind of dive in and look at the top 3 uranium stocks that really power most of this sector, here's CCJ. And you can see here it's been forming what looks to be a little bit of a topping pattern. We've got a pretty clear line in the sand right across here that if this level's broken around that 1550 mark, if price was to come down and break this, we're going to see a very significant collapse, most likely to the 20-day, which is going to also be a previous pivot low on the chart. So we got to keep our eyes peeled on these big leaders. The fact that they're chopping around is not a good sign. Another one to look at is BHP. BHP has got a little bit more of a head and shoulders pattern. This one looks like a pretty solid pattern in terms of we've got a neckline right across these lows here. This is a very critical level on this chart. And if the price was to break down through that level, we're going to see a continuation move to the downside. And an easy way to measure that is just to take the height of this head to the neckline, and you can take that momentum and move it to the downside. So if it was to break down, there is potential for a huge collapse, and it would pretty much reset, BHP in terms of price, go all the way back. So there's a lot of downside potential. And Rio Tinto is another chart. It's got a very similar pattern. It's creating what looks to be a head and shoulders pattern. You've got a shoulder, you've got a head, you've got a shoulder. And when you break a neckline, which this one's sloping down, which makes it a little more finicky to trade, but there's a lot of potential downside just to the neckline. And if it breaks the neckline, it's going to unwind a huge amount of shares. So the fact that these 3 stocks are showing potential topping signs is a big red flag for that sector. And of course, the sector's got so much attention. Everyone's been piling into it, big volume. And typically when the mass and the media is in on it, it's usually almost the end of the game. And we saw that with, GME and all those, as soon as it's headline news and everybody wants to buy a share or does buy a share, that's the top. And that's where I feel like uranium is kind of at. Doesn't mean it's going to fully crash. It just means it could go out of favor for a long time. And, I got this chart real quick. Let me pull this up. This is a long-term chart of uranium going back to 2000. And it's starting to show signs that it's making higher lows and higher highs since 2016. So it looks like it's on the upswing. I like this sector. I think long-term uranium is going to have some good demand. You look in China, the nuclear energy is kind of starting to come back. You look at the Fukushima meltdown in 2011. After that, uranium just kind of went out of favor of the price, but it's starting to come back, and it's on the upswing, this commodity. And there's not that many players in it. So some of these stocks are going to do, I think, really well.
I did hear a counter argument from uranium bulls, which is that the demand and supply fundamentals are heavily in the stock's favor. As you know, there's very little supply being produced right now in North America, but demand is more or less constant for nuclear energy. But that's an interesting take that you're giving right now, which is that there's going to be a short-term correction.
Yeah, and that's really it. I mean, this market's showing signs of consolidating for possibly several months, and then it could go longer. When I just showed you that long-term chart, we're looking at a multi-year rally in uranium. It's going to have corrections along the way, and I think it's about to have one. But overall, we're in like a major super bull market. I think precious metals and all those are going to do exceptionally well over the next 3 to 4 years. So it's just understanding the time frame you're looking at. Are you a short-term trader, or are you holding for long-term? And so you can digest and mentally control yourself during the swings, knowing where your outlook is and your time horizon.
One of our viewers was watching my earlier interviews with another uranium analyst, and I mentioned to him that I've never seen a physical raw uranium before. I don't know if you have, Chris, but he sent me a sample here. This is depleted uranium. It's in a case here like this. It's an argon casing, so hopefully I won't get cancer. It's from Luciteria Science, so thank you for sending it over. Chris,
that's cool.
I wonder if whenever there's a disconnect between fundamentals and the technicals, which is, I guess, the story here behind uranium, does that concern you as an investor? Do you stay out of the market, or do you short?
I don't short too often. We get this big disconnect. It happens all the time. We see it in precious metals too, where, I think uranium is just starting a massive bull market, the uranium stocks and uranium itself. We see this with precious metal miners, where they're out of favor for 5, 6, 7, 8 years. And then the last year you see them have this massive, 60, the index has like a 60 or 70 or 80% rally, and then fizzles back out a little bit for a while. And then it starts a new bull market. We saw that in the miners already a couple of years ago, and that was the kind of warning. So I think we're in that same stage right now where early investors are getting into uranium. They've created this first big push and pop, but I think it's kind of overdone. I think it's going to consolidate for several months, maybe even a year. But overall, I think it's already started this new super cycle to the upside, and I think there's a lot of potential. And this is money moving in before everyone really knows, I think, about the sector and the fundamentals and when things really take off, because it's still a very kind of unknown, kind of hidden commodity. I mean, it's not seen as a very clean energy to most people, nuclear, radiation, all that stuff.
Right. Okay, so final question then, Chris, tying it all together. If everything is going to correct soon, and in particular, certain sectors are going to see a significant collapse, where do you go? Where do you run?
Depending on the type of trader you are, you either move to cash. You can either buy options, trade options, write options to profit from the increase in volatility. Obviously, when volatility spikes, we have an options trading service, so we sell premium. And so when volatility goes up, you get these massive premiums, and you just let these option strategies decay over time. You just get to pocket the premium. Potentially bonds, but they're not in favor right now to really get into them. And if you're a day trader, this is when you're going to have huge volatility, intraday price swings. It'll be great for day trading. In terms of trying to short the market and make money from it, the reality is when you go back in time, the market's going to fall a certain amount before you actually have a confirmed downtrend, which it's already starting to pick up speed this week. And by the time you get this confirmed downtrend, usually within a bull market, which we're in, that downtrend is pretty much over. Price will pretty much flatline and chop around in a very tight range. It'll be tough to get that next leg lower and actually make some money. So it's a very tough trade betting against the market when we're still in a strong uptrend. You just kind of wait for it to digest and then get back in as soon as that trend picks back up to the upside.
Perfect. Chris, appreciate your thoughts as always. Thank you for the update today. We'll speak again soon.
Hey, thanks, David.
And thank you for watching Kitco News. Stay tuned for more price updates and market action here on YouTube. If you're watching this on YouTube, don't forget to subscribe.